Some of the stealthiest of the stealth taxes are taxes on your investments and savings. Stealthy because the allowances have gone down pretty dramatically in the last few years, and in some cases the rates have gone up too. So I thought it might be helpful to round up and clarify what you might have to pay if you do have investments, and we're talking here about money in banks or building society accounts and in stocks and shares, in funds or directly held in shares. Now many of those we do have shares sometimes held for many years, from the days of the Thatcher privatisations of the 1980s, of British Airways as it was then, for instance, BT, BP and so on, or of firms that demutualised when it was all the rage, Shabby National, now Santander, Standard Life, now Aberdeen, or very often some of these and others which have been inherited. Anyway, let's look at what tax might be payable on your money. If they're in ISAs, no tax, of course, whether that's cash or stocks and shares. If they're in pensions or investment bonds, no tax unless you take the money out. And then it depends how you do it. And that should be where financial advice comes in. Now with bank and building society interest, you're liable for income tax on anything over £1,000 if you're a basic rate taxpayer, £500 of interest if you're a high rate taxpayer. And the banks now have to tell HMRC, the taxman, how much interest you've been paid. They will then either send you a tax bill or change your tax code if you're on a salary or getting a pension. And if you already do a tax return, well, it's down to you to tell them. With dividends, and that's dividends not just from shares, but from funds and portfolios which we may have recommended, which aren't in an ISA or a pension, well, your allowance is just £500. And it doesn't matter whether you actually receive the dividends or not. More often than not, they're reinvested, put back into the pot. You still have to declare and pay. There's no mechanism for telling HMRC. It's down to you, I'm afraid. Now that dividend allowance has gone down from £5,000 in 2018, so a big drop, huge in fact, and the amount you have to pay is, for some reason, 8.75% if you're basic rate, 33.75% if you're high rate, with income over £50,000 of course. Now, if you have one of the sorts of portfolios which we recommend, you'll have a mix of funds, some investing mostly in shares, some in bonds, government bonds, corporate bonds, loans to governments and companies. These pay interest rather than dividends, so they fall under the Bank and Building Society interest rules, except they won't tell HMRC about it like the banks will. So when you get a statement, as you will after the end of the tax year from the platform administering your general investment account, that's the non-ISA or pension account, this will show both dividends and interest, and if the amounts are over those allowances, you'll have to pay tax on them. There's one other which you may have to pay, and that, of course, is capital gains tax. Now again, the allowances have, for this tax, fallen massively, from well over £12,000 down to £3,000 now. So if you have any shares or funds which are sold for a profit of more than £3,000, you have to declare the capital gain and pay tax on the amount over the allowance, and that's at the rate of 18% now since the last budget for basic rate taxpayers, 24% for high rate. And what they will do is add the gain to your income if you're a basic rate taxpayer. If it takes you into the higher rate, you'll pay the extra amount on the excess. So, what can you do about it all? Well, if your non-ISA and pension investments are in joint names, pensions and ISAs can't be, of course, you'll get two lots of allowances. So that helps a bit. Premium bonds are still tax-free, so don't keep all your money in bank and building society accounts. Have a chunk in premium bonds if you have enough. Government bonds, if you invest in them directly, have no capital gains tax. Can we put it all offshore in a tax haven? I'm still occasionally asked. Well, I guess if you never want to spend it, or you can stand to live somewhere like Dubai, or are rich enough to be allowed to live in Jersey, then yes, but well, you're unlikely to be our client if you can or do want to. So the answer is, well, we'll do our best to make things as tax efficient as possible, but there really isn't that much you can do but bite the bullet, and particularly with capital gains tax, think that it might be a nice problem to have, as it does mean your investments have actually gone up, which does happen.